Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There is a lot of optimism in the market right now. And what we've seen over the past month or so is that the narrative has sort of shifted from, a no landing narrative to one that's sort of like a soft landing narrative. And that's really what's supporting the market right now.
I'm not seeing anything in the pre-announcement that tells me that the business is turning around, but at least they'll raise enough cash to last another 3 or 4 years if they in fact continue to flail and try to find a new strategy. So I admire that they're taking advantage of the opportunity. That's probably in the best interest of their longer term shareholders. I feel sorry for the fools who buy the stock at 21 because it's worth single digits.
To me, the focus is they've got to announce and in place a new CEO now that they've announced that Theo Calhoun is leaving. They've got to get the Spirit deal done with and put in the books. Thirdly, they've got to get the 737 MAX authorization, increased production with the FAA increased to above 38.
We've got 1 hour to go until the market close. So let's take a look at the major averages sponsored by Tasty Trade. We've got a gain for the Dow right now, up just about 1/5% here. Pretty tepid gain here to end the week, up about 70 points on the session. Of course, touched 40,000 yesterday, has not gotten back to that level today. The Nasdaq right now trading a little bit lower by about the same amount here, off by almost 0.2%. Then if I can find the S&P 500 blindly here, but I'm going to skip that and take a look at the sectors here where we have a little more control. The S&P 500 is little change. This is what represents it on this screen here. You've got tech and consumer staples under pressure. Energy doing quite well today, along with materials. We are going to dive into commodities, specifically metals, later in the show, as copper has been having quite a wild time of it. Taking a look at the Dow here today, you've got a pretty mixed picture as reflected in what we saw. You just heard a little bit about Boeing, up about 0.8% here on the latest from the company. We are also going to get an update on its latest shareholder meeting and the headlines that came out of that later in the show. And finally, the Nasdaq 100 here. As we take a look, this is also pretty mixed. NVIDIA, the big thing on deck after the bell next Wednesday, it will report earnings. In today's playbook, we will tell you how to play the chips right now going into that and beyond. So that should be a fun conversation, Josh.
That's right, Julie. U.S. Federal Reserve Governor Michelle Bowman, meanwhile, has reiterated her stance that she is willing to hike rates if needed and says that inflation will remain elevated for some time. This coming as investors had begun to feel some optimism surrounding the Fed and interest rates. For more on where this leaves the market moving forward, let's bring in now Bob Dahl, Crossmark Global Investment CEO and CIO. Bob, it is good to see you. So I'm just looking at the market here, Bob. You know, maybe lost a bit of steam here in the last couple sessions, but market's still on track, Bob, here for its longest streak of weekly gains going back to February. And you know, Bob, why not, right? Decent economy, decent earnings. What's not to love?
Yeah, it is a love affair as momentum carries the day, as you point out. And that goes until it doesn't anymore. Momentum is impossible to predict when it's going to end. Now, if you want me to pick on things, I can do that. I'll pick on the Fed and inflation and interest rates. We got a couple of inflation numbers this past week. They were okay relative to expectations, but they're still annualizing between 3 and 4. That's nowhere near 2. I don't think we're going to 2. Second thing I'd pick on, earnings. Double digits this year and double digits next year. The U.S. has never produced back-to-back double-digit earnings growth unless we're coming out of a recession. So I'm skeptical there, and for all that, I get to pay 21 times earnings. So I'm a little cautious, fully invested, but cautious.
And Bob, let's dig a little bit more into that caution. It's Julie here. It's good to see you. Not only are you cautious, you do think there's a chance that we'll see a recession before the end of the year. What leads you to that conclusion?
I do, Julia. I'm an old man, I guess, and have not repealed recession from my vocabulary. Look, we got the leading economic indicators today, and they were down again. We've had 1 month up in the last couple of years. A week ago, we got the University of Michigan Consumer Confidence Index, and not only are lower end consumers struggling, but now some mid-income consumers are struggling. It's just the high end that's doing well. And of course, inflation expectations in that same survey went up a bunch. So I don't think all is as clear as we might like it to be in a market where you got to pay over 20 times earnings.
Bob, when you say recession, help us quantify that. How serious a downturn would you be looking for?
Yeah, our view is, and our predictions coming into the year, mild recession. There are a lot of reasons to think it's not going to be very noticeable, but I think consumption will is already beginning to flag a bit, and we'll see that in the employment numbers before long, and that'll just cause employers to say, well, I'm having trouble with my price increases. They're not being accepted like they were. I still have cost pressures, so I have some margin pressure. Maybe I'll lay off a worker or two, and you know how that goes. It becomes a vicious cycle. So not severe at all, and some will argue when we get through it, we had one, some will not, and they'll both be right. But I think a pause that refreshes is necessary.
And Bob, if, what you were saying that, price increases aren't necessarily accepted in that kind of a scenario, you see some workers get laid off and maybe wage pressures come off as a result. Does that mean that a recession would indeed bring lower prices, or would we run the risk of seeing a sort of stagflationary scenario?
I hope it will bring lower prices. I think there's a good shot at that. I think part of the problem with the Fed arguing for 2% inflation while we're having economic growth, at or above trend, that's really hard to accomplish. Getting inflation down from 6 to 4 at the core level took a lot of work, and we've done that. 4 to 2 is a whole lot harder. So you hear my skepticism absent a noticeable slowdown.
So, Bob, given that outlook, you want to stay cautious. What does that mean, Bob, when you look at the U.S. stock market? Where do you want to be invested, Bob?
So I'm owning companies, or trying to anyway, that have high earnings predictability, high earnings persistence, and strong and growing free cash flow. You might put over all three of those things the word quality. Those stocks have done just fine on the way up. And if we get any kind of pullback of that lasts more than a couple of weeks, I think those stocks will go down for sure, but go down less than the market overall. So lots of good stuff out there, but you got to do your homework.
I mean, Bob, I also wonder if you see a scenario where you maybe see a recession, but if prices come down, stocks like that enough to keep going up? Does that work or no? Or no?
Well, where we're in the throes of it, people will say, "Oh, I didn't expect any kind of recession. I didn't expect earnings to be flat or down." And so there'll be some people who run for the hills, no question. But out of that comes a recycling and restart of the cycle, and that'll be fun on the other side. And maybe small cap stocks will eventually play again in that recovery.
Hey, Bob, I don't recall, and I don't know if you have it at hand, but when's the last time we had a recession start in an election year?
That's a great question. It's been a long time. I don't know when. They typically come, as you know, in the first or second year of a presidential term, more than the third or the fourth. And so I don't know that it's going to start anytime real soon. Our guess and our prediction is we'll start sometime before the end of the year. Maybe it'll be the day after the election.
Maybe it will. Bob, good to see you. Have a great weekend.
All the best.
Thanks. We're just getting started here on Market Domination. Coming up, meme mania fading fast on Wall Street this time around. GameStop shares are sinking for a third day in a row. We are going to dive into some of today's top trending tickers on the other side. Plus, Boeing shareholders re-electing outgoing CEO Dave Calhoun, at least to stay on the board of directors, as the company aims to stabilize production and quality. More on that in the 4 p.m. hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into two stocks to help you make the best choices for your portfolio. Stay tuned, more Market Domination after this.
Microsoft making strategic moves as it gears up for its Build 2024 event next week. And one move being in its video game sales strategy. The software company reportedly aiming to release the coming installment of Call of Duty to its subscription service. For more on what's new in tech, we have Bob O'Donnell, Technalysis Research President and Chief Analyst, joining us now. Bob, it's good to see you. So let's start there, Bob. And by the way, this was the Journal reporting this, that yes, Microsoft's going to add the latest installment of that powerhouse franchise Call of Duty to its Game Pass subscription service at lunch, Bob, instead of, selling it a la carte. What did you make of that, Bob? Big deal, no deal? How did you see it?
Well, I mean, look, I think it's an evolution of what Microsoft is doing on their gaming business in general, right? And they're seeing this subscription model, as we've seen in every other aspect of the tech industry, be something that they want to take advantage of. And so not really a surprise. I mean, honestly, it's kind of like one of the last pieces to fall into this idea of a subscription-based model. So I think it makes perfectly logical sense. Increasingly, that's what we see. It's almost impossible to find something you can buy on its own now when it comes to software anymore. So not a surprise, and it's a way for them to get more excitement around Game Pass.
Bob, at the same time, this was something that Bobby Kotick of Activision Blizzard was resistant to, right, over time. Now he's not there anymore. Does this do anything to the Activision franchise, to the Call of Duty franchise, in terms of a hit to reputation at all because they were so resistant? Or, because as you said, everybody's doing it now, it's not really going to matter?
Yeah, I don't think it hurts Activision at all. I mean, it was going to happen eventually, whether those guys wanted it or not, because the outside world, again, everybody's moved to this kind of a model. So, I just feel like this is something that would have happened eventually, and they're just making the decision to do it now, and they feel like they have the opportunity, like you said, since things have changed there. And again, it's all about getting more subscribers. At the end of the day, it's as simple as that. And so in the same way that, Netflix has got to have new shows and everybody else has got to have new content to get people to keep motivated, to maintain those subscriptions, this is the exact same thing. And again, consumers are used to it now. You're not making it any different from anybody else. No game feels better because it's not on a subscription. I mean, I don't think people think that way anymore.
And Bob, as we mentioned, sticking with Microsoft, next week is the company's big Build conference. I know you're going to be watching. This week was OpenAI and Google. Next week, it's Microsoft's turn to talk AI. And front and center there, Bob, certainly there's going to be a lot of talk about Copilot. That's Microsoft's AI assistant. And, it is early days, Bob, but certainly, there are investors and analysts on Wall Street who are excited about that tool and kind of the potential growth and adoption. What do you think?
Well, look, I mean, Microsoft jumped out on this early on, right? We saw OpenAI do the ChatGPT thing about 18 months ago. And within 3 months, all of a sudden, Microsoft was talking about integrating the OpenAI stuff into their tools with Copilot. So they jumped way out ahead of everybody else. And frankly, what we've seen since then is a lot of scrambling and catching up by the Googles of the world, by the Amazons of the world, by the Metas of the world. And now it's getting obviously significantly more competitive. So, the expectation is that they're going to continue to build on what they've done with Copilot. They brought it out into Office. We've seen that. I expect to see that get developed further. So, I mean, they're going to keep building on the thing that they started and integrate it. And I think, one of the big stories that's going to be interesting to watch over time for Microsoft and all these players is, hey, you know what? We've been talking about proof of concepts and all this kind of stuff. Let's see it in actual production. And so what I expect is that you're going to see them talking about, are there new tools potentially that that companies can use to make the process of integrating this stuff into their environment easier? Because the reality is there's a lot of companies out there who are super excited about this, and they've tried some things here and there, but to move that from, hey, we're playing around with it, to actual production is much harder. And so I think you're going to see some of that. They've already done some of that. I expect we will see more. You're going to see their competitors do this as well. So it's going to be interesting to see. But, this is the year where I think, and I've said this before here, even on Yahoo Finance, this is the year when AI really starts to have an impact. And then eventually we start to see even more of a bottom line financial impact. We've started to see it. I expect we're going to be seeing more of that over the next 12 to 18 months.
Hey, Bob, specifically to build also, there was a Reuters report this morning that Microsoft plans to offer this new suite of AMD chips to sort of compete with NVIDIA chips. What are sort of the implications of that for everyone concerned?
Well, look, I mean, to be honest with you, I'm kind of surprised it's taken them this long. I mean, everybody is doing this, right? I mean, everybody is looking at AMD because NVIDIA makes incredible products. People love it, but nobody likes when there's one company that completely and utterly dominates. And so that's why you've seen so much focus on, additional players and additional competitors and additional alternatives. AMD has been out there plugging this story for a while. They make great products. And from the people who've been really diving in deep into this stuff, they're saying, look, they actually absolutely can be competitive with NVIDIA. So it just makes completely logical sense for Microsoft to do it. Again, their competitors are starting to do it as well. I think this is just part of that general move towards a diversification of suppliers. We've got Intel is going to be pushing their Gaudi chips. Obviously, they're trying to get in there. You've got all these companies building their own custom chips. We've already seen that being announced by all the major players. So this is that sense of, look, all of this stuff is important, but we can't rely just on NVIDIA. Yes, we're going to buy a ton of NVIDIA, but the growth opportunity is so big, we need others to help us build this as well. And this AMD move just seems like another version of that.
Bob, let's switch gears, talk Apple as well, because we got this report that Apple is developing a significantly thinner iPhone, could get released as soon as next year, Bob. I don't think we know exactly how thin, but thinner, and according to this report, pricier. Let's say this report is true, Bob. I guess that's Apple then moving kind of even harder into the high end of that smartphone market, Bob?
Well, I mean, here's the thing, Josh. I mean, I don't know about you, but I mean, honestly, how much thinner do these things need to get? Like, do we really care? I don't know. I shouldn't be so negative. But, look, they showed what they could do with the new iPad Pros, right? Thinnest product Apple's ever produced. They obviously set a standard there with that. Now the idea is, let's bring this to the iPhone. There was another report that just came out today or the day before about moving to a new type of more dense battery, because the battery is the thing that, to be honest with you, that's kept these phones as thick as they are, because you need a certain amount of battery life, and therefore that implies a certain thickness of the battery. If you can get a more efficient battery, theoretically you can get a slimmer phone. There we go. We get a slimmer iPhone, and some people will pay the premium because they want to have the coolest, latest thing. In the long run, I don't know. I'd much rather see an Apple foldable, to be honest with you, excuse me, than a thinner one. But hey, I guess we'll take what we can get.
Hey, Bob, who knows? Maybe thinner and foldable. I mean,
yeah,
crazier things have happened. Bob, thanks so much for joining us. Appreciate it.
Thanks, guys. Always a pleasure. Always.
Time now for some of the day's trending tickers. Reddit shares, they are surging after announcing a partnership with OpenAI. Team up intended to enable OpenAI's AI tools to better understand and showcase Reddit content. So companies saying in a statement here, Julie, this is going to enable OpenAI's AI tools to better understand and showcase Reddit content, especially on recent topics. So this means OpenAI can train AI systems on Reddit data. Financial terms, we don't know. Those did not get released. Of course, this was sort of part of Reddit's pitch when it went public, increasing revenue through these very kinds of licensing agreements with AI companies and powerhouses like OpenAI.
Right, and this is they've done a bunch of these thus far. I think there's something like 200 million or so that they have signed in deals that we know about or that have been reported on. One of them was with Google for $60 million as well. And for OpenAI's part, it's been making these different partnerships too. There are a lot of questions about this. As you pointed out yesterday, how are Redditors going to feel about this? And one story in the background that especially throws that into relief here is that OpenAI reportedly is now getting rid of this, what they call their super alignment team, which sort of is a curb on the development of general artificial intelligence, which is making AI that sort of is meant to mimic human intelligence and go beyond it. That would be a curb on allowing that to overpower its creators, kind of like what you see in sci-fi. That team is no more. And that has raised some concerns. This was sort of one of the things at the crux of Sam Altman's ouster from OpenAI and then his reinstitution Why am I bringing it up with the Reddit story? Well, if you're a Redditor and you're worried about the use of your content that's on Reddit being used for eventually some sort of nefarious or just purposes you don't want it to be used for, I don't know. There's just still a lot of questions about this whole area.
There's big questions for Reddit users. Investors like, just one point I make, Roth MKM's Rohit Kulkarni, friend of the show, in a note this morning, so he's a fan of Reddit, we know that, he's a buy on the name, says this kind of AI sentiment helps with near-term momentum. We saw that today. Also says he would not be surprised if Amazon now finds a way to work more deeply with Reddit too. And remember, because what he's saying there is Reddit long-term AWS customers, so we'll see if Rohit's right.
Yes, we will. All right, let's talk about Tilray Brands, too. That company announcing an at-the-market program to fund strategic and accretive acquisitions. The company's planning to sell shares as it looks to prep for a U.S. cannabis rescheduling. What the heck does all of this mean? Basically, the company says it is registering to sell $250 million in shares for potential sale. It doesn't mean it's going to.
Right.
It means it potentially could do this. And it made it very clear in its statement that it's not using this money for operations, that it would exclusively be for acquisitions once this from Schedule 1 to Schedule 3 gets done in the United States.
Yeah, and this has come back to the topic we were talking about a lot this week, Julie. This is Biden administration looking to reclassify marijuana as a less dangerous drug. Stock has been interesting, down obviously hard today. It's also down hard in the red this year, but also, just pull it back a bit. Nice pop recently, up about 15% in the past month.
Yeah, so they're taking advantage of that.
Yep. All right, finally, let's look at GameStop. AMC stocks sinking today after the meme madness returned this week, but they weren't the only stocks caught up in the craze. Yahoo Finance's Inez Ferre is here to take a deeper look at some of the smaller names that saw some big moves this week. Inez.
Yeah, Josh. So everybody has heard of GameStop and AMC, but have they heard of Faraday Future, Intelligent Electric? Well, I hadn't either until we saw what this stock was doing. This is a microcap stock. It is a company that's worth about $20 million. Take a look there. You're looking at it down 29%, but it was up more than 120% today. Over the past week, at one point, it was up more than 7,000% for the last week. On Monday, this stock was trading at 6 cents. Earlier today was trading at over $3 a share. Now you are seeing it at over $1 a share. It's incredible what has happened with some of these stocks. Faraday, by the way, was the third most mentioned ticker on Reddit's sub-forum, Wall Street Bets. It was behind NVIDIA and behind SPY for the Spider ETF, S&P 500 ETF. Another stock that was going crazy this week as well is called Crown Electrokinetics. That stock for the week is up more than 200%. That's a fiber optics and a smart glass microcap company. Also, Greenwave Technology. This is a Virginia-based metal recycling company. SunPower also this week is up for the week after a crazy a few days. And Microcloud Hologram, that's another solar play that was up today more than 6% at one point. For the week, it's up about 22%. A theme that you see among a lot of these smaller companies is that they are very small companies and the short interest on them tend to be really high. For Faraday Future, short interest was more than 92% of the float. So obviously any move is exacerbated, guys.
Yeah, most definitely. And a lot of these companies, just like Tilray we just talked about, like GameStop, are taking advantage of the spikes in their shares to register to sell more shares. So that's an interesting corollary to what's going on. Thanks a lot.
Thank you.
Well, as the meme trade finishes off a wild week of price swings during trading hours, stocks like GameStop and AMC see big gains quickly, then to flip throughout the week. But what if the traditional 6.5-hour trading day were to change? Yahoo Finance's Josh Schaefer is joining us here with more. So we're talking 24 hours.
24-hour trading, yes. I've been asking a lot of folks in the space about that over the last month now since we had, that report from the Financial Times that the New York Stock Exchange was polling its investors about what it would like to see from 24-hour trading and any general interest there. The New York Stock Exchange has not actually made an announcement on moving to that or anything like that, but sort of just speculating on what it would look like, right? And one of the exchanges that we track already does have some version of 24-hour trading. So Robinhood has what they call 24/5 trading. And so 5 days a week, you can trade for 24 hours on Robinhood. Getting back to the meme stock part of this, earlier this week on Monday, they said 12% of their action on GameStop came actually before the open. So in that 24-hour session. And largely, it seems like that's what strategists and people that are in the exchange space think this would look like anyway. Is people are still going to trade during the day. This is really a play for two different groups of people. One would be international investors. We have seen the companies, specifically in the S&P 500, the big companies we talk about all the time, a large portion of their revenue is now out of the US. And so people that live outside of the US want to invest in those companies. The exchanges see an opportunity to essentially appease that demand and be open during those hours. The other flip side to this too is just you can do everything on your phone now for 24 hours. And there's a younger generation of investors coming in right now, specifically the group in their 20s, that has only grown up being able to do everything on their phone. And again, as an exchange, which we should remember are businesses, right? If there's demand for someone to trade for 24 hours,
want to meet it.
The exchanges are going to want to meet them where the customer is. And they feel like that younger generation of customer is on their phone all the time, and they want to be able to give them access to trading.
Yeah.
And for investors, Josh, what would be the pros and cons of this?
Yeah, I mean, the pros, Josh, like I said, is just more access. I think from a institutional standpoint, the CME group had told me that they were looking at it from like a risk perspective, right? When you see the opportunity to be able to hedge risk before the market opens, what you're looking at right now is daily volume in non-US hours on the E-mini Nasdaq 100. That's increased since 2019 and stayed relatively steady there. That's been an interesting development. People, as news happens overnight, being able to react to it. And then sort of the drawback would be, what if there aren't enough people in the market at 2 a.m. Eastern, right? And what does that do to liquidity? It seemed like some of the strategists I talked to thought that that won't be that big of an issue, but I think it a little bit remains to be seen because we haven't really gotten there yet. Of if we open this all the way up and you can trade at 1 a.m. Eastern, what is it going to look like? The fear would be if there's low volume, then there's not going to be the people to come in to buy the stock, right? When you look to sell it at a certain price, right now that spread when you have high volume is pretty narrow. That spread could widen significantly if you're trading in low volume hours.
Did they get rid of the bell at the New York Stock Exchange?
You know, we were talking about, I talked about
there will
that.
still open at that time, I guess.
Right, yeah, so maybe they don't. And I think if we're still going to see a lot of people trading in traditional hours, then
Right, which we probably will.
maybe the bell still matters, right? It's our time to log off if we want to log off.
Got it. All right, Josh, thank you. Appreciate it. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned, more market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today, we're examining your leisure spending dollars. Where are they going? Joining me here to discuss is James Demert, Main Street Research Chief Investment Officer. Good to see you again, James. Thanks so much for being here. So let's get to the stock you do like first, and that is Booking Holdings. As we are still seeing people travel to some extent, the stock has done well over the past year. So let's get to your case here. And first of all, it starts with the growth and it starts with the profit margins, both of which are about 20%. So 20% sales growth, revenue growth, we're talking about specifically there, right?
Yeah, and 20% profit margin and a consistent profit margin, and which and a 20% grower of earnings. So those two consistent numbers are really one of the things that we think is so fabulous about this company. Based in Amsterdam, we're global investors, so we love looking at the U.S. companies, but also these companies based in Europe.
Right, and of course, Booking also has a big business here in the U.S. as well,
do they
as well as globally, a lot in Europe as well. Now, there's a lot of places to travel to book your travel right now, right? But you say they have built a moat around the business model. Explain what you mean there.
They really have. You know, in the beginning when they started out, the big competition was that Google would get in the business, right. Amazon, right, with this tremendous amount of cash flow. And they tried, but they were unable. And over time, what's happened is Booking has just created what I call a moat, right? This sort of hard to penetrate market share. And the more they have this, the more it continues to be a stronghold. What's really interesting about, and I think what creates that moat, it's the ease of use of their web access. And now they have an AI trip advisor.
Of course they do.
This thing tells you where you want to go, what car you might have leased before, even your thread count of your sheets. I mean, it's really pretty amazing.
Wow, I like that filter. I'm going to have to click on that one the next time I book something. And then finally, there's the valuation that you're looking at as well. And, you know, that you are seeing that growth that you pointed out, but at what you say is a good valuation.
Yeah, I think, you know, here outside of AI and all that stuff, you want a consistent grower that's not a tech stock. This is a 22 times their earnings, growing at 20% a year. I think it's just a really great, consistent part of any portfolio construction.
So as you know, we always like to talk about what could go wrong with the stock. And in this particular case, you know, you get another pandemic and travel stops. That's sort of something you can't control. Or if we do get more meaningful economic slowing, that could be a risk.
Yeah, that's really the risk. You know, anything that would cause people not to want to get out there and travel. But right now, that is not in the way. And hopefully it doesn't come in the way, certainly the pandemic.
Right, knock on wood, seriously.
Yeah.
And you are a holder of Booking.
Both my family and my firm, yeah.
Gotcha, okay.
We eat our own cooking.
Gotcha, well, it's good to know. Let's get to the stock you don't like. This one is quite interesting to me. It's Disney. This stock has also done well over the past year, in part as the proxy battle has been going on. But in terms of why you don't like it, the first reason is quite interesting to me. Bob Iger came back to the company, but you say some of the decisions made by his predecessor, Bob Chapek, took the company down such a wrong path that they can't be reversed. What are some of those concerns?
Yeah, and I think Bob Iger, right, he's just a fabulous manager, and he was there for so long. But I even think for him, it's too little too late. The previous manager dug a hole strategically, and too much time spent and too much money spent, that I'm not sure that Iger is really the right kind of turnaround guy here. Iger's great at building businesses and being creative. Now he's coming in basically trying to pick up the pieces and clean it up. I'm not really quite sure, and I don't think shareholders might be either. Of course, we have Nelson Peltz who came in, and that made it even more difficult. So management is the big problem there, and I'm a real stickler for buying companies with excellent management, with visibility. This is a bit of a mess when it comes to management.
And one of the messes you contend is what has happened with streaming and sort of the spending on content that the company has done. Is it not sort of paying off for them, do you think?
You know, it was a difficult, very competitive goal to try to compete with Netflix.
Yeah.
I mean, the monster, not just in the US, but globally. And that was really the whole strategic idea behind previous management. Let's make Disney this very competitive streamer against Netflix. it's just like sending the Cleveland Browns to play, the Kansas City Chiefs, if you're a football person.
Yeah.
It just has not worked. And the problem is, it doesn't look like it's going to work, and it's been very expensive and very time consuming. So that is sort of something I think Iger is going to have to wrestle with. And the question is, do they just cut their losses and move on, or they try to turn it around?
Yeah, I mean, he has sort of tried to trim down the spending, but you don't think he's gone far enough.
Again, too little, too late, I think is the problem there.
And then valuation, just like we talked about with Booking, you think this stock is overvalued?
Yeah, it's growing at 5% a year, right? Compared to Booking at 20, but it's trading at 25 times earnings. And typically you want to have PEs equal to the growth rate. So 25 times earnings and growing at 5% is far, far away. So that valuation proposition doesn't make any sense to us.
So what could go right for Disney? And you pinpointed two things that could potentially go right for Disney and turn this around. One of them is that the company changed the business strategy meaningfully and things get better. The other is it becomes a takeover candidate, which, I mean, one of these seems a lot likelier than the other one, at least to me.
It's a Bahama to take over. I mean, it would take a ton of money and somebody who wants to, get involved in that mess. But, when we think about, okay, what would make it appealing? Yeah, takeover, hard to imagine who the acquirer would be. I think it's a change of strategy, and a significant and dramatic one. I'm not sure current management, Iger, is really up for that. It's going to cause a lot of conflict. So, but those are the two things I think that could cause it. I think if the stock just fell apart, like went down a lot, it could be compelling.
Right.
But not at, with these levels.
And clearly you don't own it.
No, we don't own it.
Okay, just making sure.
Thanks.
And you're not short it.
We're not sure.
Okay, James, good to see you again. Thank you so much. Let's summarize what you're telling folks here. Buy Booking Holdings. It's a growth company that's reasonably priced. It has a well-built business model with a good moat. On the other side, you say avoid Disney. It's falling down the rabbit hole, from previous management. And the stock's overvalued, and it's facing drawbacks as it spent all this on streaming competition. Thank you so much for being here.
My
Good
pleasure.
to see you. Thank you so much for watching. Goodbye or goodbye. Be sure to tune back in next week for all new episodes at 3:30 p.m. Eastern.
It was a busy week in the media sector, the industry's top names unveiling their upfront presentations to advertisers. But it wasn't the shows making the big headlines. It was the focus on advertising technology. Netflix announcing its own ad tech platform and will make its ads available to programmatic buyers, including the Trade Desk. Shares of TTD jumping on the news this week. For more on what this means for the company and its business, we're joined now by Citi analyst Yigal Arounian. Yigal, it is good to see you. So what this basically means, Yigal, as I understand it, is that the Trade Desk is going to help facilitate automated ad purchases for Netflix. Kind of walk us through, Yigal, just what bottom line this means for the company. What kind of financial impact do you think it's going to have?
Yeah, sure. So look, this is a really important set of inventory for the Trade Desk. And just to kind of level set, Trade Desk is a demand-side platform that essentially connects advertisers with various digital platforms that's across the web collectively. That could be online video and display ads, but the fastest growing and biggest part of their business is into connected TV. As connected TV has become bigger, it's continued to take share from linear television, and that's really early stages and growing. The Trade Desk is the largest independent demand-side platform playing this role within the ad tech ecosystem. Netflix is still really early in terms of its ad offering. It's about 5 or 6% of total CTV ad dollars. But opening up to the Trade Desk here is going to be really important because Netflix is 20% of viewership, and that ad platform is expected to grow. So what that means, bottom line for the Trade Desk, and on our estimates, we think that the billings, the dollars that are running through the Trade Desk in 2025, it's an incremental $500 million, or about 3 to 4% of growth. That's just in 2025. And then as Netflix gets bigger and CTV ad dollars and advertising continues to grow in 26 and beyond, it should continue to be a larger impact.
Yigal, Netflix, and it's Julie here. It's good to see you. Netflix didn't just open it to Trade Desk, it opened it to a couple of competitors as well. But do you think Trade Desk is really best poised here to take the biggest share? And do you think, and what are we seeing, I guess, from the other streaming platforms also?
Yeah, hey Julie. So it opened it up to a couple of other competitors. So when Netflix first came out with its ad tier, it was partnering with Microsoft. Over time, the decision was to bring some of the capabilities in-house and then expand the relationship with multiple partners, really with the ultimate goal of letting more ad demand come into the platform. The Trade Desk and the role that it plays as really the largest independent demand side platform. They have a ton of relationships with large advertisers, and they'll likely play a really important role in bringing in this demand. They also partnered with Google and their demand side platform. Google is really more oriented towards its own platforms and YouTube in particular. But the Trade Desk, one of the biggest differentiators for them is that they are agnostic essentially. They don't own their own inventory. And that's one of the things that advertisers like a lot. Trade Desk is plugged into at this point really all the leading CTV platforms except for YouTube and Amazon, who really control their stack top to bottom on their own, don't have those outside partners.
You look at Trade Desk, nice run, right? It actually hit a 52-week high just this week. It's up about 30% this year, up around 40% over the past 12 months. But you look at valuation, Yigal, as an analyst, is valuation still supportive here?
Yeah, so valuation tends to be the biggest pushback on the stock. It's been the biggest pushback on the stock really on that 40% run up as well. It's definitely not a cheap stock. There's a real premium to that. It's trading at about 40 times next year's EBITDA. So certainly a significant premium. But we think that's justified. You look at the growth rates. Trade Desk has been growing mid 20%. We think that there's upside to the numbers this year. When you look at the Netflix contribution next year, we think there's upside now to numbers next year. CTV is about 40% of the Trade Desk's billings, and it's been growing. And CTV is in very early stages still. You think about viewership, it's moved away from linear. We're about 50-50. So 50% of viewership is on streaming, 50% is on linear. That's going to continue to move. But when you look at TV ad dollars, it's about 25-30% that's on CTV versus linear television. So the ad dollars haven't caught up yet. The streaming platforms are pushing more and more subscribers to the ad tiers because it's more profitable. So we're in early stages of maturity here. Trade Desk is a really dominant platform in the role that it plays within the ecosystem. So we see real good long-term growth for the Trade Desk. They play a really important role. And those are the reasons why you can justify that kind of valuation.
Yigal, going to take a little left turn here because we want to ask you about Wayfair and this news that the company is opening a bricks and mortar location. There have been other online retailers that have done this, but most of them are not necessarily in businesses that have really seen a physical footprint shrink. Like I think of Bed Bath & Beyond, for example, and yet here is Wayfair going the other direction. What do you think of it?
Yeah, definitely left turn, different topic here. What's important to understand for Wayfair's strategy here is that this isn't them going all in into bricks and mortar. It's going to be a slow rollout, very strategic. The way the company and management talks about this is that over time they still see 50% of their categories, so home furnishings, being done offline, right? And they want the opportunity to capture that offline part of the market too. There's plenty of synergies that they can get between the online business that they built and an offline business. I wouldn't expect them to go and launch hundreds of stores across the U.S. within the next couple of years. It's going to be a slow and steady rollout. But there's a way to leverage that offline and online component. Allow some consumers that want to shop in store and sit down on a couch, for example, and have that opportunity to give them that opportunity. So it's an interesting strategy. It could be a more meaningful part of the business. For now, it's going to be a slow rollout.
Yigal, good to see you. Have a great weekend.
Thank you. You too.
We are days away from NVIDIA's blockbuster earnings report. Does the stock still have room to run, and where else should you be in chips? We'll discuss in our investor playbook on the other side. The pressure is on. NVIDIA will report its first quarter results next week. Expectations are high, and NVIDIA's stock reaction post-earnings could make or break fellow chip makers and the broader market for that matter. So can the semiconductor giant deliver? To discuss, we're joined by Matt Bryson, Wedbush Senior Vice President of Equity Research, and William Stein, Truist Securities Senior Analyst. Guys, thanks so much for being here. Matt, I'm going to start with you. Most of the research that I've been seeing out there thinks, well, even if they beat, the stock might not go up.
Yeah, I mean, that's what we've seen in a few of the recent quarters, right? It's not NVIDIA beating that moves the stock. Stock is flat to down a little bit. But having said that, then what you see is momentum 1 week, 2 week, 3 weeks later as people digest the news and realize that there's been absolutely no slowdown in AI spend or demand for NVIDIA data center GPUs.
William, let's bring you in here as well, because like Matt, you are an NVIDIA believer. You got to buy on the name, William. When you're talking to clients and they ask you, what's kind of on your wall of worry for Jensen Huang's company, what the downside risks are, what do you tell them, William?
Well, sure. I think it's pretty clear if you look at the stock and the valuation at, trading in the low 30s times calendar 25 earnings, it tells you that, relative to the very fast growth that we've seen for this company over the last few quarters, it suggests that there's a downturn coming. And when you see lead times go from a year plus to less than half a year in a couple quarters, that's usually an indication that, hey, customers have double and triple ordered. Now perhaps we're going through a period where they get delivered, and then suddenly, hey, I don't need any more for the next few quarters, and let's back off. We're going to cancel orders, and then you see a downturn. I don't think that's what's going to happen in the next year plus. I actually don't think it's going to happen through 24 or 25. I argue, very strongly against this view, but I think that's the worry. It's much less for this stock around, do they beat the quarter? I think certainly they're going to beat this quarter, and I think they're going to beat in the out quarter guide as well. But I think the real question is what happens through this year and into next year's numbers. Does the company give us an indication that we're going to continue to see growth and very strong demand both for units and for integrated systems where the company's getting the growth from?
Will, do you think there's any indication they won't continue to see that kind of growth?
Well, sure. The indication is there, right? And it's in the lead times having gone the other way, having shrunk in the last couple quarters. When I visited the company in September, they were telling us lead times were over a year. I hosted meetings with them at CES, and they were saying they're down to less than half a year. That sends signals to investors that, look, we're heading for a period of cancels and push outs and, potentially negative revenue growth. We've seen that in this end market, in this data center end market, twice in the last 5 or 6 years. It is certainly going to happen again. I just don't think it's going to happen this year or next year for that matter. That's absolutely a concern.
And let's talk, guys, too, about AMD, because here we have a disagreement on the panel about that name, which makes things interesting. Matt, start with you, because you're bullish on AMD. How come, Matt? If you were to bullet point that thesis, what would it be?
It's simply AMD is the only alternative right now to NVIDIA. So I'm basically at little over $4 billion in data center GPU sales, going towards $10 billion next year. That's enough in my mind to support a $200 valuation for the stock. And you look at kind of the other indicators out there, like I see supercomputing as an early indicator of what trends are going to be in the general business environment. And there, AMD is the only other choice other than NVIDIA. So I think they do well in AI, if not as well as NVIDIA. But then I also think we're starting to see a pickup in standard server builds. I think they're gaining share there. I think that's a tailwind that will benefit them through 2024 into 2025 as well.
Will, as Josh alluded to, you've got a hold rating on AMD. Why are you not looking at that as another big, beneficiary of what's going on with AI demand?
This company is certainly going to generate revenue from AI with this MI300 product that they're ramping today. I think that's no doubt. But when I consider the longer term prospects for this company, we've got two problems. One is that, in my view, x86, the traditional core Intel compatible CPU market, is sort of a shrinking iceberg. And this is because of what NVIDIA is doing in the data center. They're getting customers to buy entire NVIDIA systems that are displacing this x86 standard that's been in place for many, many years. And the other issue is that in AI world, what NVIDIA has, its advantage really has something to do with its chips, but not as much as one would perceive. The reality is that NVIDIA's position, its advantage in AI, is really owing to three different things. It's a culture of innovation, it's an ecosystem of incumbency, and it's a massive investment in software, services, and pre-trained models now. It's especially that services and software bit that's super important. There's a massive 4 million person large community of trained CUDA developers. These are developers that develop to NVIDIA's systems. If AMD has 400,000, a tenth of what NVIDIA has, I would be gobsmacked. Right. That is the advantage NVIDIA has. It's very, very difficult for AMD to build against that, in my opinion.
Well, we'll see how it plays out, gentlemen. Thank you so much and have a great weekend.
Thank you.
Well, you just heard the closing bell on Wall Street. Now it's market domination overtime. Jared Blickery is with us now to get you up to speed on the action from today's session, sponsored by Tasty Trade. Before we get to him, let's take a quick check on where the majors ended up here, because we did have the Dow closing above 40,000, up just about 1/3%. The S&P up marginally, the Nasdaq down marginally. Jared's got a closer look now for us.
Yes, Julie, that should have been a record close for the Dow, and we're looking at gains for the week. If we can go to the Wi-Fi Interactive, I will show you. Here's the Nasdaq, down fractionally today, so no record close there, but up 2% for the week. And we'll take a look at the Dow as well. There you go. Finally got a close over 40,000, as you were saying, and we are pretty close to the highs of the week, which were also the highs of yesterday. Now, let's take a look. I want to take a look at the VIX first, and then we'll get into some heat maps. The VIX now trading with an 11 handle. You can see this is the lowest point in the year, so that is a tailwind for equities, but this is also the time to be buying protection. You need to buy protection when you don't need it. But here is the sector action for today. Energy in the top spot, up 1.4%, followed by materials, and also financials, discretionary, healthcare, communication services round out the top row. Tech and staples took a back seat today, but for the week, here we go. We got tech in the pole position, up 3.1%. And in fact, the only losing place in the week, at least in the large cap sectors, is industrials. If we take a quick look there, we can see Boeing up 3.6%, Freeport up 5%. That's a gold play, but GE down 2, Raytheon down, RTX down 2, and a couple others. CMI down 4.4. Also want to cover meme stocks because that has captured the imagination of traders and investors this week. Here is the 5-day look, but I'm going to leave you with the 1-day look. We gave some back today and the last 2 days. So GameStop looks like it's going to end in green for the week, but not today, down 20%.
All right, thank you, Jared. So the Dow closing higher for the 5th week in a row, and today closing above 40,000 for the first time ever. Here with more on the path ahead for investors is Ryan Kelly, Hennessy Funds CIO and Portfolio Manager, along with RBC Capital Markets U.S. economist Michael Reed. Welcome, guys, both of you to the show. So Ryan, maybe we'll start there. Dow closing record high, above 40,000, a big round number. It's going to get attention and headlines. What's been driving this, Ryan, this market rally, and do you see that momentum continuing?
Thanks for having me on. I think that obviously there's a lot of exuberance in the market right now. 40,000, huge number. We've never seen it before as far as a closing level. This is for a few different reasons. Obviously, the expected next move for the Fed, even though it might be quite a ways out, is to lower rates. Also, we have the idea and the worry of a slowdown in the economy or a recession. That's all kind of behind us as well. So you put those together, and I think that we're setting ourselves up for still a pretty good year from here forward.
Michael, you're here with the Sunset. Is the idea of a recession put to bed? I mean, we talked to Bob Dahl of Crossmark at the top of the show. He's still worried about one before the end of the year. What do you think?
Sure, thanks for having me. We don't see a recession ahead for the U.S. economy. We do see a lot of tailwinds, especially in the consumer space. One thing we've talked a lot about is the rise in retirement assets, both portfolios that are increasing in value and the sheer size of the baby boomer generation that's retiring and starting to draw down those assets. That's showing up in the economy in terms of consumer spending. So that's a really strong tailwind.
And Ryan, back to you. So you say you're looking for a pretty good year for the rest of 2024 here. Ryan, how do you want to put money to work in this environment? What are you screening for?
Well, I think we stick to what we always do here. One of the spaces that we really like, which has lagged the rest of the market, it's a little bit better valuation metrics than the broader market right now, is the mid-cap space. We have always liked mid-caps here at Hennessy. But in this particular time, I think that, first of all, this market move we've seen really since last October is more broad-based. So that's really good to see. It's not just large cap tech or working from home stocks that we had 3 years ago. It's much more broad-based. And in fact, this year already, while the overall market, the S&P is up about 12%, a lot of the sectors are about that same amount as well. There's not really one major sector pushing the rest. So the mid caps, we like them because they're big enough to matter. They've gotten to a certain size already. They can still grow a lot organically because they can still take market share or maybe move into other industries. And yet they're still important enough that a larger cap company could acquire them. So you put those together along with a little bit better valuation right now than our overall market. And I think mid caps are a pretty good place to look going forward.
Michael, kind of switching back to the economy here and talking about the different sort of parts of the economy, I guess if you're talking about corporate size, right? Although you probably think more about consumer income tranches, right, and how they're doing. Kind of walk us through your thinking on where the consumer is in those different tranches right now.
Sure, and I think where some of the recession talk is coming in is when you look at the lower income spectrum. We are seeing things like credit card delinquencies rising, auto loan delinquencies are on the rise. And those folks that do rely more on credit for their spending are feeling that pinch of higher rates. On the other hand, when we think about those higher income earners and especially retirees, a lot of their income is being boosted by higher interest rates. So interest income is something that is a bit of a tailwind at the higher end of the spectrum. But in neither case, I think what's important for the economy, getting back to this concept of retirees, that's going to put downward pressure on the unemployment rate. So even those folks who are feeling that pinch of inflation can be pretty confident that they're going to have a job, over the course of the next year. We don't really see the unemployment rate rising meaningfully above 4% through the end of this year.
Since you have talked a little bit about the retirees, I want to bring up a sort of a provocative idea that Rick Reeder of BlackRock talked about in an interview with Bloomberg recently, where he said the answer is actually to bring interest rates down in order to bring inflation down. And he reasoned that because so many people, not just retirees, but lots of people, are putting more money in fixed income because they're getting a high yield on that, then they have that money to spend. And he argued if you cut the rate, then that money will come out of fixed income. People won't be earning as much on it. Does that, if I'm explaining it correctly, does that make sense to you?
Yeah, I think you have the right idea there, and that, in a sense, does make some sense in terms of where the pressure is for services spending. Where we look at the strength, we see it in categories where the 55 plus cohort tends to be overrepresented. So things like dining out, hotels, travels, and medical care is another big one for that particular segment. So if you take away some of the spending power from kind of the higher end of the income spectrum, that would take some of the strength we do see in the consumer.
Ryan, back to you. So you sound generally constructive on the market, Ryan, and told us kind of how you're screening for names. Can you give us a couple names, Ryan, that would be just kind of representative holdings in the fund right now?
Absolutely. So in the Hennessy Cornerstone Midcap 30 Fund, we look for companies that are are trading at a good valuation, for companies that have some momentum behind them, and companies that have earnings growth. So the interesting part about this portfolio is that you'll find names that probably aren't talked about a lot and probably aren't in a whole lot of other portfolios either. We own Gap, Abercrombie & Fitch, and Guess. We purchased all those last October. Abercrombie, for instance, is up 150% since that time. These are companies that were out of favor. They were trading at fine valuations when we look at them, but they had turned a corner, and then because of various reasons, number one, the consumer stayed strong. The holiday season was excellent. They've done very well. We own right now a couple other names that they are HVAC system companies. They provide heating and cooling, Modine manufacturing, as well as comfort systems. Both those companies, again, fit our criteria. We added them to the fund, and they've done pretty well. So, this fund is an interesting fund in that we're not buying the same kind of names that you might talk about or see a lot, but they're at good value as far as we see them. And so far this year, it's worked out pretty well.
And I'm curious, because we talk about a lot of these names maybe that are being affected by higher for longer interest rates. Is that a risk when you're talking about, especially something like HVAC, which maybe people are financing in some cases, right? Is that a risk?
It can be a risk for in particular for these HVAC companies. Interestingly, I think they're actually a tertiary type play on the AI, on what's going on in AI. We have the AI companies, we have the the hardware and the networking companies that are also benefiting from the AI boom, and then you have, interestingly, building companies and HVAC systems that are benefiting as well. So there's some of that going on. But as far as overall interest rate risk in the portfolio, we don't really have as much of exposure to that. We don't really have many financials. Utilities that are more cyclical, we don't really own those as much. So they don't really kind of make it into the portfolio in general. So this is more of an idiosyncratic type portfolio, and you're not going to see a lot of those macro trends affecting the individual companies quite as much.
And as we're talking about interest rates, Michael, I want to close it out with you and ask what you think is going to happen this year with rates.
Sure. So we are looking for the Fed to cut this year. Importantly, we don't see them really being able to do so until December. Partly that's because of the election, but also thinking about what happened with the last CPI report. While April was a step in the right direction, it doesn't provide that confidence that we're on a sustainable path lower. So we really need to see that trend continue and see prints that are closer to 0.2 or even 0.1 on a month-over-month basis. That would allow the Fed then to start their cutting process.
All right, Michael, Ryan, thank you guys both for joining the show today. Appreciate it.
Thanks for having me.
Thank you for having me.
Still to come, silver and gold prices higher today. We're going to speak to a strategist about the latest moves in the commodity space on the other side. Stay tuned. More Market Domination Overtime coming right up. Welcome back to Market Domination Overtime. Jared Blickery is standing by to get you up to speed on the action from today's session, sponsored by Tasty Trade. Jared.
Thank you, Josh. A little bit of red today from the Nasdaq, but for the week, we are looking at gains across the board, and I'll hit the Nasdaq here. Over the last 5 days, you can see a gain of over 2% there, and the Dow, which finally closed over 40,000 Friday, that's up 1.24%. And it was kind of a week where we saw a lot of the fringe parts of the market, a lot of parts of the market that haven't been doing well recently over the last few years, really come back in a lot of ways. Now, tech, I'm not going to put tech in that basket. Here are sectors, but tech was the best performing sector of the week, followed by real estate and healthcare. Here's industrials down here. But what I want to show you is what's happened with some of our leaders. Bitcoin came back up about 6-7%. GBTC up 10%. We have Chinese stocks. We can see Alibaba up 10% this week. Some of these others up 7 to 15%, depending on where you look. If you look at unprofitable tech, the disruption trade in the U.S., those are the ARC innovation components. We saw a lot of those coming back, led by Tesla, the biggest here, up 5.3%. And if we take a look inside our meme stocks, well, we see a lot of green here, but you might be surprised to learn who the leader was for the week. Not AMC, not Koss, not GameStop. It was Tupperware. Tupperware up 70%. And that's simply because GameStop and AMC and the like, a lot of those stocks gave back some of their gains from Monday and Tuesday throughout the week. I'm going to close here on crypto. Bitcoin never sleeps, so we're going to be geared up for the weekend of watching crypto prices here. As I said, up 6% over the week. But the leader here, Solana, up over 14%. And here's Chainlink, up 21%. Guys?
Thanks, Jared. Well, while stocks are up 4 weeks in a row, one area of the market that is really shining, get it, is metals. Gold is up 1% on the day, but taking a look at the other metals, silver and copper in particular, are surging as well. Joining us now, Bloomberg Intelligence Senior Commodities Analyst Mike McGlone. Excuse me, Mike, it's good to see you. Thanks for being here. I want to start with copper, which has just been such a fascinating story as of late. There have been all kinds of sort of odd supply disruptions. Just for people who haven't been following it as closely, walk us through what's been going on.
Hi, Julie. Well, the significance this week is pretty profound short covering in futures. The CME traded contract that trades in New York, there was some decent short covering those front contracts. It really pumped up the front contracts into a decent, I think most significant backwardation in about 10 years and pulled back, which is oftentimes a sign of highs. And so that contract closed at an all-time new high and made new highs, but the LME contract that trades in London did not make a new high, but it's catching up. So to me, right now, what I see is more shenanigans in futures. The futures contracts as a percentage of open interest, managed money net positions, i.e. hedge funds, are very long, about 30% of open interest. So they're already on top of this trade, which is a bit of a headwind. Now, the more macro, there is decarbonization, digitalization, electrification, but there's been some supply issues out of South America and Panama. But overall, I'm more worried for copper that its autocorrelation tendencies will carry through. It usually has a tendency to spike and go down. And basically, the way I say it right now, it's just catching up to gold. Gold has been the star performer in metals.
Mike, I also want to get your take on silver, which has had such a move here. Is this, is it a story, Mike, about industrial demand, or is it financial demand, or is it both?
Well, the macro for silver is it's industrial now. Basically, gold has demonetized silver, but it's known as the devil's metal for a reason, because it has a tendency to spike and then go right back down. So right now, it's the same price as it was for, I guess it's about the highest level since 2013. So it's 11-year high. It's breaking out. The way I see silver, it's stuck between gold and copper, and it's catching up to gold, and it's got copper in its back. And there's potential rumors that, we know China's been the biggest buyer of gold, not just Chinese central bank, but citizens. There may be some hoarding of silver, but the key thing I'm more worried about silver is that it might follow that path, that autocorrelation and path in copper, where it spikes and then goes back down. In the macro, the big picture, though, I'm very favorable in terms of commodities, most favorable to metals versus most other commodities.
So give us a little bit more detail there, Mike, about then what you expect to happen next. Do you expect that spike and to come back down in a copper, or do you think that there will be a more sort of sustained action here?
Well, we'll start with the most enduring trend commodities, and that is gold outperforming most commodities. I think that's accelerated. I think it's going to continue. And to me, it's just a matter of time gold gets to $3,000 an ounce. I don't know when. Now it's got very good support now below the market around $2,200. And ETF outflows have been significant. At some point, those have flipped higher. I think that's going to take a little bit of a peak in the stock market. And to me, that's the problem with more industrial commodities. Silver is an industrial commodity now. Copper is an industrial commodity. At some point, we probably should see a little bit back up in the stock market. And it's pretty expensive here. Mentioned earlier, the VIX is running around 11% handle. The S&P 500's 22% above its 100-week moving average. That's pretty much oftentimes a headwind for industrial metals. And then there's China. The key thing I'm worried about in China is Chinese CGB 10-year note yield at 2.3%. It's the lowest in our database. It's over 200 basis points below the U.S. That's a sign of deflationary, recessionary inklings in China. So I'm worried about that macro for industrial metals. And the key thing is beta. If beta can keep going up, industrial metals will do fine. But in both environments, I think gold will outperform.
Mike, how about the Fed? How does that play into your thesis on the precious metals?
Well, there's where I think gold is figuring it out. I don't think the Fed is going to ease until the stock market goes down and tells them to. It's kind of silly for the Fed to ease with pretty massive speculation and inflation above its targets in most markets. So that to me is the problem. But the issue right now we have in the stock market is the total capitalization of U.S. stocks is about 2 times GDP. That's the most since the 1930s. So it's basically all that matters. Stock market goes up, sticky inflation. Stock market goes down, inflation goes down. And that to me is part of the problem. And that to me is what gold is figuring out. On the year, gold's up about 17%. The total return for the S&P 500 is around 11%. So that AI-driven stock market is actually being beat by the rock. When the rock beats stocks, you should beware. And I think the rock's going to continue to beat stocks.
Yeah, that's so fascinating to me. And also that even that they're correlated at all, right? That they're going in the same direction. How historically unusual is that?
Well, typically the correlation is zero. What the big thing was around 2008. Initially, the stock market went down, gold went down about 30%, and then took off as the Fed started easing. I think it's going to be similar. The difference this time is stock market is so much more expensive now than it was then versus GDP. There was almost 1-to-1. Now it's 2-to-1 versus GDP. So I think it's still, obviously I'm a commodity guy, I admit that by bias, but the main commodity I think is going to continue going higher is gold. And if we get the normal back and fill in the stock market, and you haven't had a 10% correction since October, then that's going to probably launch gold, maybe with an initial pullback. But the bottom line for gold is the deepest pockets on the planet. Central banks led by China are buying the metal. And that, according to the World Gold Council, looks like it's early days and enduring.
So wait, I just want to make sure I heard you correctly, Mike. You said if you had to bet on any one commodity right now, it would be gold.
Oh, yes. Well, I have to admit I've been saying that for a little too long. I admit that because, the thing is that gold got to the point of maximum disdain. How long did it bump above 2000? I mean, I was bullish gold in 2019, 2020, and it just made me lose more hair. So to me, it's just catching up now. But it's that macroeconomic situation where relative to the stock market, gold is very cheap. Stock market relative to the GDP is very expensive. And then we have this unlimited friendship between President Xi and Putin. It shifted the world order. A lot of the world's kind of trying to get away from the dollar, and the first place to go is gold. So Bitcoin in that space. So to me, gold is still, and gold also has a history of beating most commodities in terms of performance, particularly in an environment where you see bond yields declining. Now we're seeing that in the rest of the world, i.e. Chinese yields are declining, and I think it's a matter of time that stock market gives back a little bit, allows U.S. yields to go down, and that potentially could accelerate this rally in gold.
Mike, it was great having you on the show today. Have a good weekend.
Thank you. You too.
Outgoing Boeing CEO Dave Calhoun will remain on the company's board. It's following a shareholder vote earlier today. The move comes as the company tries to stabilize production and quality. And joining us now with more is Alexis Keenan. Alexis.
Hey, yeah. So there were two really closely watched issues in the shareholder vote. One was that you mentioned there, Calhoun, stay on the board, don't stay on the board, despite that he's stepping down as CEO at the end of this year. And it was against the advice of proxy advisor Glass Lewis. So the other issue was whether to approve Calhoun's 2023 executive compensation at $32.8 million. He's been CEO of Boeing since January of 2020. Now, both of those votes coming in yes. So the new board will have Calhoun. He'll be the only non-independent director there, and then he'll be among the 11-member board. Now, meanwhile, Boeing also looking for its new CEO and also trying to recover from the two fatal MAX 737 crashes, also that one non-fatal accident in January back with that Alaska Airlines fuselage door that detached at 16,000 feet. So Boeing really having this sky of really red tape, also including a pending decision from the Justice Department that has already said that the company violated deferred prosecution order that was attached to those two fatal crashes in 2018 and 2019. And so the DOJ, they're deciding whether or not it will criminally prosecute the company. We should know that by July. Also, lawsuits tied to that Alaska Air incident. You've got government investigations ongoing. You also have more oversight across the company and its production. Also, really just its tarnished reputation from all of these aircraft failures. Now, during the shareholder meeting, Calhoun was asked about the company's financials, wanting to know, one question was wanting to know if the company would go back to restoring its dividend. It was suspended back in 2020. But to respond to that, Calhoun said, well, the job number one is first returning to a steady cash flow. And they said that the objective was to do that by 2025, 2026. He said he was hopeful about that. So far this year, stock down since January, about 30%. And also coming up for this company, Boeing is scheduled to meet with the FAA in 2 weeks. And at that time, they're going to have to present a plan to get their house in order. This is something that they've been working on. And what they're presenting to the regulator is a way to, many ways, to enhance quality across the company, across production, across manufacturing. Guys.
Alexis, just quickly here. I mean, listening to this litany and everything that's going on, one could be forgiven for saying, why the heck did they approve him remaining on the board and on the pay package? Do we have any insight into the thinking on the part of shareholders?
Yeah, I wish I could tell you, Julie. It was a real quick brush. Yes, it's approved. There was very little talk about it at the meeting, but it was absolutely against the advice of Glass Lewis. And certainly a lot of people skeptical about the fact that Calhoun was at the helm at the time when this Alaska Air door came off of the aircraft in flight back in January. So he's stepping down, but he's going to remain a member of the board. I guess the positive news for some critical shareholders is that he will be the only non-independent board member at this point. Since 2019, the company has kind of done an overhaul of its board, and they have a lot of new board members. And they did mention during the call that a lot of those members have engineering experience, something that critics have wanted to come back to the company for quite some time.
All right, Alexis, thanks so much. Appreciate the update. Time now for what to watch next week. Starting off on the earnings front, we're going to see another big batch of earnings next week, but all eyes, of course, are going to be on NVIDIA. The tech giant is the last of the Magnificent Seven to report this season. The company announcing first quarter earnings for fiscal year 2024 after the bell on Wednesday. Analysts expecting NVIDIA to report another strong beat and raise from rapidly growing AI investments.
And sticking with earnings, we'll also get reports from Target, Synopsys, and e.l.f. Beauty, among others. Target announcing first quarter earnings ahead of the open on Wednesday. That company hampered by tight consumer spending, according to analysts, and revenue could remain under pressure as consumers continue to focus on essential goods over discretionary.
And finally, the Fed is releasing its minutes from the May FOMC meeting on Wednesday afternoon. We're going to get more insight into Fed officials thinking around monetary policy as we wait for the next meeting in June. This coming after some commentary today from Fed Governor Michelle Bowman reiterating that she's willing to hike rates if needed.
And that'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. There's more Yahoo Finance coming on the other side. Are you traveling this summer? Maybe to the Olympic Games in Paris, or to go there to see Taylor Swift's Eras Tour. Our next guest sees signs of life in summer travel in the U.S. and abroad this year. Here to talk more about it is Kevin Davis, CEO of JLL Hotels and Hospitality Americas. Of course, he was in Paris this week to see Taylor Swift. No, I'm just kidding. I don't know. Maybe you were. You could have been.
You told me something I didn't know.
So, yeah, where are we seeing the flows happen here when it comes to hotel activity, when it comes to travel activity?
So we are incredibly optimistic about summer travel. It's interesting. We expect a lot of people to hit the roads and take to the skies. If you look at AAA surveys, they expect travel will be up about 4.5% this Memorial Day relative to last year, about 2.5% compared to 2019, which is a benchmark year for us. So we're really excited about that. If you look at the airlines, United Airlines, for example, expects this to be the most traveled Memorial Day in the history of the company. So
Wow.
they expect 3 million customers that weekend, so they're preparing for that. So if you look at the trends, we are very bullish about people taking to the roads and to the skies this summer and staying in hotels.
And Kevin, when you look at hotels, are there certain kind of sectors where you expect to see more activity than others? You know, luxury, for example. Where's it going to see most activity?
So performance of luxury hotels has remained strong post-COVID and continues to remain strong. So we expect that luxury will continue to perform. We also think that urban hotels in the major cities, what we would call big box and or full service hotels in the big cities, will continue
Remind
to
me
perform.
again, Kevin, what's a full service?
So it's a hotel that has rooms and then also food and beverage, and typically meeting space as well, compared to a select service hotel, which generally has skinny down food and beverage offerings and typically has very little to no meeting space.
So like room service versus no room service, probably.
That would be a full service hotel.
That would be one
Yes,
indicator.
Yes, that is correct. But we expect, look, if you look at the internet searches, a lot of queries about Orlando, New York, Los Angeles, San Francisco, which is an interesting market because that has been a troubled market, but we're starting to see some green shoots with travel to San Francisco. So we're excited about that.
Well, that's good. That's a great city to visit.
One of the world's best.
We know it well. You know, when you talk about the increase in travel and what the airlines are seeing, obviously they have had their own troubles because of capacity, because of what's going on with Boeing. I'm curious about capacity in the hotel business, especially you have Airbnb, you have Vrbo, you have other things. How's this sort of supply-demand match in the hotel business?
So one of the interesting things, I mean, both can coexist healthily. We've seen that. We have seen a recovery in occupancy in traditional hospitality, but frankly, we are not back where we were pre-COVID. I think part of the reason is because hoteliers have generally pushed rates, average rates, pretty significantly. So it's just more expensive to stay in hotels, and they've sacrificed occupancy as a result. But we are starting to see occupancy recover. Leisure travelers have been back since 2001. They were the first to hit the road post-COVID, but we're seeing a return of group travel, so meetings, and also corporate travel, which is another thing that's driving our occupancy. On the Airbnb side, they've seen some slippage, but at the end of the day, we think that Airbnb and or short-term rentals will have a strong summer, as will hotels.
And Kevin, what about hotel investment? I'm just curious what kind of trends, themes you're seeing so far this year.
So investment activity is down about 38% compared to last year relative to the larger transactions that we typically track. I think a big driver of that, frankly, is just interest rates and the high cost of debt. If you go back to early 2022, before the Fed started raising rates, you could borrow against a hotel at 4 or 5%. Today, that's 8, 9, or 10%. So because the cost of debt has gone up so much, it's really curtailed investment activity. And we saw that in 2023, and we're absolutely seeing that continue in 2024.
And the projects that you're seeing, is it more construction or is it more renovation? I mean, when you're talking about, for example, urban, where you're seeing a resurgence, I would imagine you're not seeing a lot of new hotel building, but you're probably seeing some revamping.
That's correct. We are seeing some new construction, but it's very expensive to construct. We had a significant run-up in inflation, which has affected all aspects of the industry, but it's expensive to build relative to buy. So in many cases, you can buy an existing hotel at a 30 to 40% discount relative to what it costs to build.
Wow.
As a result, you have more people buying, and the cost of capital for building is incredibly expensive. So most of the activity, investment activity that we're seeing, you're seeing it in urban hotels, big city center hotels, but you're also seeing it in resorts, which is an area where we've seen a lot of investment post-COVID, which has continued. I'd say probably the biggest change or the one constant in most of the deals getting done today is people are generally buying hotels with existing cash flow. There are exceptions to the rule, but because the cost of debt is so high, it's important that the hotels generate a reasonable amount of cash flow to help cover the cost of debt service.
And Kevin, when you talk about hotel investment, are there differences regionally to call out that are significant?
Yes, I would say absolutely. Look, you've had a recovery in some of the urban markets like a New York, like a Boston, which markets frankly lagged in the recovery post-COVID. So you've seen more investment in those markets. And again, you're still seeing investment in some of the coastal and resort markets. I would tell you that some of the states, frankly, which had a lot of investment post-COVID, Florida, for example, you've seen a step down in investment activity, but we expect that it will resume in the near term. But it's driven by the fact that there was such a high peak, so we're down relative to that high peak.
Kevin, can we ask a hotel guy, what's your favorite hotel to stay in?
Oh my gosh, all my children are beautiful. I can't answer that.
Come on.
I can't answer that question.
Good answer, Kevin.
Right? There you go.
You can tell us off camera.
Kevin, thank you. Always love having you here.
Thank you. We appreciate it.
Peak travel season is on the horizon, and while oil and gas prices stabilize this week, consumers should prepare for some potential pain to their wallets. Let's get to Yahoo Finance's Inez Ferre with those details. Inez.
Yeah, Josh, and the EIA had recently said that they are forecasting that gasoline prices could go up by about 10 cents per gallon this summer on average, to average around $3.70 per gallon for the summer. And this is because of refining capacity being lower, also because of refining costs. These refineries are older refineries. It's expensive to maintain them. And it's estimated that over the last several years, you've seen refining capacity down by about 7%. Now, earlier today, we spoke to Gas Buddy's Patrick DeHaan, and he had said that he doesn't see that 10-cent rise necessarily this summer. He thinks that the prices are going to be around the mid-3 range. Right now, you're looking at the average of gasoline at $3.60. A month ago, it's $3.66, so it's 6 cents lower from a month ago. And a year ago, it was at $3.53. Of course, if this summer you do see some hurricane action, especially around the time of August, certainly we could see prices spike around that time. As far as oil is concerned, we have seen oil inching higher. Part of this has to do with the drone attacks from Ukraine that are continuing against Russian refineries. You also had that stimulus out of China to prop up its housing market, so that is bullish for oil. And so we have seen WTI today settling just below the $80 a barrel. That's a resistance level for WTI. Brent crude settling above $83 a barrel, guys.
Inez, thanks so much. Appreciate it.
Thank you.
Coming up, a Mercedes-Benz plant in Alabama has rejected joining the United Auto Workers Union. We'll get you the details when we come back. A Mercedes-Benz plant in Alabama has rejected joining the United Auto Workers Union by a vote of 2,642 to 2,045. With more on the story, let's welcome in Yahoo Finance's Pras Rahmanian, who's been covering this closely. It was close.
Yes. Yeah, it was. I mean, it was going to come down to the wire. There was kind of thoughts that it could go either way. He said that vote came down to a 44% yes vote versus a 56% no vote there. So still, it is not a totally close vote here. You would say this is definitely a majority here saying no to the UAW. Sean Fain just had a presser with the media and mentioned a couple of things that obviously not the result we wanted. These workers reached out to us because they wanted adjustments. What happens next is up to them. While the loss stings, we'll keep our heads up. These workers have nothing to feel sorry for. We'll continue to carry this fight on, so it's not the end. You know, when that VW plant in Chattanooga voted yes, it was the third try that it took for them to vote yes on, and that was over 70% vote. So we'll see if they go back to Alabama. There's a pending NLRB investigation on sort of union busting activity on the part of Mercedes. So there's some stuff going on there that might sort of turn the tide maybe for another vote. We'll see, but kind of, you know, he said that it's not going to stop our momentum, but it is a kind of a stinging loss here for them after the big wins in Detroit last year, and then also in Tennessee earlier this year.
Do you think any sense, Pras, maybe they kind of lick their wounds and then target, you know, other companies? Because there was some hot talk about, you know, maybe Sean Fain had Toyota or Hyundai in his sights.
Yeah, you know, they probably have these next sites in planned for, and they said they did polling in the state of Alabama, and it was 2-1 that people wanted to join the union, but obviously that doesn't always translate when you go into the factory and there's Nick Saban coming to visit them and speaking to the workers. Our friend EP Rachel talking about that. But you know, there's stuff that happens in the factory floor that changes sort of those perceptions. So they probably have the next place in mind. Maybe it is going to be Alabama again, because they have the polling. They'll look at where they can sort of get a victory, and we'll see them. There's definitely not over.
But they're focusing on the South, right? That was part of the significance here, was sort of breaking into the South and expanding union membership at the auto plants there.
Yeah, it's these plants in the states that aren't union friendly.
Right.
They're trying to find, you know, apparently they're saying back in the day, Alabama was a pro-union state, believe it or not, and things have changed over time. So they're going to find that next sort of candidate for them that, I mean, they need to build a momentum, right? This was not exactly a good thing to happen, and Sean Fain was pretty sober on the call today.
Yeah, because listen, if you're Sean Fain, you're trying to reverse these trends in membership that you've been seeing, and that's what he was counting on, for sure.
Yeah, I mean, this would have been a huge victory if they would have gotten it. So.
All right, Pras, thank you, buddy. Appreciate it. Coming up, we're speaking to the CEO of Linktree to break down how a TikTok ban impacts the content creator economy. Stay tuned. More Yahoo Finance on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
There are more than 200 million creators competing for market share. That's according to a report by Linktree. That market is the creator economy, and Linktree is one company trying to unify it. For more, we're bringing in here Alex Zakaria, co-founder and CEO of Linktree. Alex, it is good to see you. So you all released this kind of deep dive into the creator economy, and maybe we could start there, Alex. Maybe describe and quantify how big that creator economy really now is.
Yeah, look, the creator economy is already huge, and it's really growing. We're seeing year-on-year increases. We estimate around 200 million creators creating content for commercial intent, and we're seeing that continue to grow. We see, in 23 alone in the US, around 50% of Gen Z say that their purchasing decisions were influenced by a creator. And on Linktree alone, over $6 billion in GMV has been driven by creators. So it's a really integral part of the US economy and the global economy. And yeah, we're hoping to see it continue to thrive.
And Alex, talk to us about, so for people who aren't familiar with Linktree, like if somebody says link in bio, frequently that's a link tree, right, that then takes you to all of their content. What's the sort of division among social media for the sources for your creators that are using your service? Like, can you give us sort of a percentage breakdown of how that looks?
Look, and this is actually really part of the problem for creators, and one of the challenges that they're facing, that the internet is incredibly fragmented. TikTok, Instagram, Facebook, YouTube, Threads is another recent one last year. And we're talking Pinterest. There's so many platforms that creators need to show up on. And the reason Linktree exists is to help creators and small businesses to be able to really unify all of their audience coming from all of these different platforms, and to be able to drive them off to wherever they need to get to whichever other platform they need to help unify or monetize, and for them to own that audience themselves, which is really important. We're seeing, we are seeing all the platforms grow as a percentage against each other. We are seeing TikTok continue to grow in leaps and bounds compared to other platforms year on year.
And Alex, for our audience here, can you walk us through a bit about sort of the economics of Linktree, your business, how you make money?
So Linktree is a freemium SaaS platform. So there's the free tier that's really designed to be super powerful for as many people as possible to use, and then there's a $5, $9, and a $24 a month plan for if you want more powerful analytics, or if you really want to dive in a bit deeper into some of the functionality. And then also what we're really focusing on right now, which we're super excited about, is our social commerce play, which is Linktree Shopping. And it's really a way for creators to be able to actually build a store on their Linktree and make sure they can continue to own their audience. It's pretty unnerving right now for creators where they're building their audience on these platforms. They're competing with algorithms, they're competing with AI, they're competing with the ability to own their content, and they're competing with the potential for those platforms to maybe go away where they have built their audience. And so they are looking to build their own shops and be able to sell their products on their Linktree, and that's another revenue stream coming up.
Alex, I was struck by the stat from your creator report from last year. Only half of creators made any money at all from their content last year. And of those that made money, of the 50%, only 2% were making enough to maybe live on, more than $50,000 over the course of the year. 72% made less than $500. Does that raise some questions about the sort of breadth of the creator economy?
Yeah, look, it does. It is a really challenging career path. It is kind of like any other market where there is a bit of a power curve. The top 1% do well. There's an increase in middle class, and then there's a long tail. And we're working really hard to increase and continue to democratize that, so that the end of that long tail can have more opportunity to reach those dollars. And so there's many different ways creators can make money. Often it's through brand deals. And we want to help continue to connect the dots there, so that more of that long tail, we can raise that number so it's far more than 2% that's actually earning a living or earning the wage necessary to live comfortably in countries like America. And we are seeing that increase. We are seeing creators continue to be the storefront. And we at Linktree, we really believe that over the next 5 years, we'll continue to see Linktree be the storefront for brands. We don't think there'll be brands will be putting ads on billboards or doing necessarily big TVCs. They're reaching their audience through these creators who are right now influencing purchasing decisions. And so we hope to continue to see that grow into have more of the creator and passionate economy earn a living.
Alex, thank you so much. Good to get a temperature check on all of this from you. Appreciate it.
Thanks for having me.
That wraps up our show for today. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
And stay tuned for the debut of our new show, Asking for a Trend, weekdays at 4:30 p.m. Eastern Time. Have a great weekend.